Well, with a joint venture, you can have an investment of money in a common enterprise with an expectation of profits. But every investor has to be actively involved in generating their own profit. So they're not relying on one person to generate the profit on their behalf. They're all actively involved. And so that is the distinction, is that they have to be actively involved, and it has to be more than just a voting right. So in a syndicate, where someone is selling investment contracts, usually they're going to gather the money all up front. They're going to say, here's how we're going to spend the money, and then they're going to administer it. In a joint venture, it would be more typical that you would not gather all the money up front, that one person gets to decide how to spend. You would ask people for money when you need it to hire a contractor or when you need something. You're not taking control of other people's money.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba. Today, I have a very, very special guest with me, my good friend, Kim Lisa Taylor. Welcome, Kim.
Hey, thanks for having me. Hi, Vinki.
Yeah, so excited to have you back. A little bit about Kim. Kim is a nationally recognized corporate securities attorney, speaker, and author of #1 Amazon best-selling book, How to Legally Raise Money. So that's what we're going to talk about today. He's the founder of Syndication Attorneys, PLLC, and investormarketingmaterials.com. She has been responsible attorney for hundreds of securities offerings for real estate entrepreneurs who are raising money from private investors. And today we'll be discussing how to legally raise private money. So Kim, before we dig deep into raising money, would you please share your background briefly with us?
Yeah, well, we just hit a really important milestone. Last year, we compiled data for our insurance application. They make us do it. We've done over $2.75 billion worth of offerings.
Wow, congratulations. So excited.
Thanks. But I've been doing this since 2008. I've been speaking. I wrote the book, updating the book right now. So if anybody wants to get a physical copy of the updated version mailed to them, they can actually text. I'll give them a text that they can text later on.
We can add it into the show notes. Yes. Mm-hmm.
But I've just been traveling around. I've got a huge schedule this year, going around to different events, teaching, training, presenting, sponsoring, and just looking forward to getting through the year and, post-COVID.
Awesome. So tell me a little bit, how did you start in syndication? Because you're a syndication attorney, and how syndication works.
So I actually had a prior career as a professional geologist, working as an environmental consultant for about 10, 12 years, and looked in my future and said, I don't want to keep doing this. I'd like to do something else. So decided to go to law school, went at night, and continued working as an environmental consultant for a while until I figured out what I wanted to do. I started working for different attorneys, trying to explore different practice areas. I practiced homeowner association litigation, environmental litigation for a while. Realized I'm not a litigator. I like putting deals together. Met somebody who was doing syndications, met an attorney that was doing syndications, worked with him for a while, and then we started a firm. And then later on, I branched off on my own and moved to Florida and set up a Florida practice. So that's how I got here. Now, the reason that I actually met that person was because my husband and I were at a multifamily training event for RE Mentor, learning how to buy multifamily properties. And of course, the first thing we learned is, well, you have to have money to buy them. You have to figure out how to do that. So we went to the first ever RE Mentor private money boot camp. And that's where I met the other attorney that I was working with for a long time.
So can you tell me a little bit about the syndication, how the syndication works? Because the way I understand is when you syndicate a deal, you're basically creating the security. Is that a true statement?
you first have to figure out if you're selling securities. And the way to do that is that there's two ways that it applies in the real estate context. One is if you're offering promissory notes to investors. So if you're in a business that repeatedly borrows money from private investors, then you are offering issuing securities in the form of promissory notes that would trigger having to comply with securities laws. The other way is if you're selling investment contracts. And so when you're selling passive interests in a company to private investors, then you're also selling these investment contracts. The technical definition is an investment of money in a common enterprise with an expectation of profits based solely on the efforts of the promoter. And when you hit those four prongs, that's called the four-prong Howey test. When you hit that prong, those prongs, and you are now know that you're selling these investment contracts, you are selling securities, and that too triggers having to comply with securities laws. And so what does that mean? It means that you have to either register your offering, which means getting pre-approval from regulators prior to even offering it to anybody, or you have to qualify for an exemption from registration. And the exemptions each have a very specific set of rules that you have to follow as far as what kind of financial qualifications the investors have, maybe how many people with certain financial qualifications can be in your deal, and they may completely prohibit advertising, or if you are going to advertise, then you're stuck with a different group of qualifications for your investors. So each exemption is it's easily followed. These are self-executing exemptions, meaning that you have to document how you follow the rules in case you're ever questioned by a securities regulator or, some investors opposing counsel. You'd have to be able to prove that you followed these rules in order to claim these exemptions.
So you have to work with the attorney in order to get that exemption. Because basically what you're saying, when we're raising capital from the private investors and we are making decisions on their behalf because we're taking their money and then we are running with the property, making all the decisions, the share that they have in the deal is that's a security, right? So how would the exemption play a role in that if we are not registering it day one?
Well, so you don't have to register it. You've just got to make sure that you're following the rules and then document how you're following the rules. So the first thing a securities attorney can help you do is understand when I talk to people all day long. So people schedule an appointment with me and then they'll explain to me what it is they want to do. And then I'll try to help them figure out which is the best exemption for you that's going to meet your goals and criteria. And so it could either be, a Regulation D Rule 506B is a very common exemption. Regulation D Rule 506C, if they choose the 506B, which is where everybody starts, it allows them to raise an unlimited amount of money, so no limits on the dollars that you can raise. You don't have to count the number of accredited investors in a deal, but you do have to count if you have any non-accredited investors in your deal. You can only have 35, but you can't find them through any means of general advertising or solicitation. And the way to prove that is to be able to demonstrate that you had a pre-existing substantive relationship with those investors prior to offering the opportunity to invest. So that's Regulation D Rule 506B. This is where everybody starts. The reason everybody starts here is because if you jump into an exemption, there is an exemption that will allow you to advertise. It's Regulation D Rule 506C, but it restricts you to only allowing verified accredited investors to invest with you. So they have to actually go through a verification process to prove that they're accredited. And you can find them, you can post, on social media, you can find them through newspaper ads, you can hold, dog and pony shows and get people to invest with you that way. But you've also cut out about 90% of the investing public, and you've probably cut out a lot of your family and friends who aren't accredited but could be fine investors. So until you've built a track record with your family and friends who will invest in you because they believe in you, then it's very hard to go out and advertise, because the first thing a stranger is going to ask is, how many have you done before? So you haven't done it before, then you're going to have a hard time getting over that hurdle and getting people that don't know you to invest with you. So you do have to go that route. Say it's a very large raise, then you would have to bring people into your management team that have that kind of a track record and experience so that you can talk about the track record and experience of your management team.
Mm. And I heard there's another law that's like you can raise 506B capital first, and then if you couldn't raise enough, then you can close right there that, not exactly fund, you can raise capital under 506B, and then you close that, and then you can start 506C after that.
Here's the problem with that. You have to have a gap of 30 days between when you stop raising money for one and start raising money for the other.
Oh, really?
Yes. So if you have 90 days to close on a property and it took you, 6 weeks to get through due diligence and you just got your documents, you got 6 weeks left. You don't have time to stop raising money for 30 days and wait and then start a new offering. So it's really not a workable and feasible option.
If I recall correctly, I remember that the Securities Act was or came into picture enacted in 1933, right after the 1930s crash. So can you shed some light on that, or your insight, how or what transpired from there, or how it's protecting today's investor?
Well, so the Securities Act was passed in order to protect investors who had been subject to some unscrupulous investment schemes with no federal regulation. There were individual states that had regulated the sale of securities, but in order to escape jurisdiction, someone who was scamming people could have just hopped from one state, gone to another state, and then been able to escape prosecution. So the feds realized that there needed to be an overarching federal law that made it a crime to commit fraud or misrepresentation in the connection of sale of securities, and then went on further to define what securities were. And that's where this big long definition came from that includes notes and investment contracts. And then there were some subsequent acts that created the Securities and Exchange Commission and also created rules regarding investment advisors and securities broker dealers and who could sell securities without a license. And so collectively, the 1933 Securities Act, subsequently there became in the mid 1980s, people were saying, hey, why do we have to register our offering and get pre-approval before we raise money from our family and friends? Right. And so there were a whole bunch of people doing country club deals, they call them. Right. So somebody in the country club would be like, hey, what are you doing for your investments? Oh, I'm buying an apartment complex. Well, hey, I want to do that with you. And then they'd go talk to an attorney and say, oh my gosh, you have to get pre-approval from regulators. We can bring in investors and all that. And it was just such a big ordeal that, people petitioned the SEC and said, we want to be able to do this with our family and friends. Why can't we? And they said, okay, we'll create this friends and family exemption. And that's where Regulation D Rule 506 was born. So originally that was the whole rule. Then later in 2012, the Jobs Act was enacted. And what that did is it was trying at a time when the banks had virtually stopped lending, right? So Fannie and Freddie were still supporting loans on multifamily properties, but other CMBS loans were not available. And the capital markets kind of stalled. And so in the Obama administration, the Jobs Act was passed that said, hey, we're going to start helping create capital when this other capital is no longer available so people can start raising money from private investors. So that's when people were at that point saying, how come we can't advertise? This is a world of social media. This is a world of the internet. We've got it. We're now in the 2000s. Why can't we use those media to be able to bring in investors? And so the SEC relented and said, okay, we'll propose a rule that allows you to advertise freely using whatever media method you want, but that's where you're going to have to restrict it to verified accredited investors only, because the SEC is really concerned with protecting what they call retail investors. ordinary people with jobs, savings, limited resources, maybe not able to recover if they lose, 150 or $200,000 in a single deal, and versus accredited investors or investors that have over $1 million net worth or over $200,000 a year income if they're single, $300,000 if they're married. The SEC presumes that they're kind of wealthy enough and smart enough to be able to protect their own interests. So that's where Rule 506, the original rule that came into play in the 80s, was split into this Rule 506B, which is still what the original rule held, and then 506C. But then the SEC also added a third part, which was Rule 506 Part D, like dog. And with that, they said, but we're not, if anybody's ever been in trouble with securities regulators, either at the state or federal level, or they've been convicted of postal fraud or any other financial dealings with investors, we're going to prohibit them from participating in these deals in the management capacity, or even owning more than 20% of the interests of any class of these deals, so that they can't exert control over management. And so they created this, it's called a bad actor rule. So now what's happened is that, before anybody could go out and do an offering, we've actually enacted a policy where we require all the members of the syndicate managers that are being proposed by one of our clients have to undergo a background and a bad actor check to find out if they are disqualified. And in the event they are disqualified, then they wouldn't be able to participate in that capacity.
Great. Thank you for sharing that. Let's talk about the crowdfunding too at this time, because I know there are so many crowdfunding platforms out there now. They are doing basically 506C funds. But I heard recently that there is a crowdfunding platform out there where 506B or sophisticated investors can participate too, but they just kind of create a fund from there and they can plug into 506C deal. Are you aware of that? How does that work?
Yeah, I'm not familiar with that particular platform, so I wouldn't be able to speak to what specifically they're doing. But generally, in order for a 506B offering to be able to buy into someone's 506C offering, remember 506C restricts only verified accredited investors. Right. And so if you're creating a company that is going to have to qualify as an accredited investor, the definition for a company is it has to have over $5 million in assets, or all of its members have to be accredited investors. So you could do a 506B offering that's limited to all accredited investors and invest in a 506C offering because you would pass the test of all members being accredited, or you'd have to have $5 million in assets in order to qualify as an accredited investors in a 506C offering. So you've got to be cautious of what you're investing in. Some people, what I think you're referring to is called a fund of funds model. And the fund of funds model is fraught with sand traps, shall we say. Because if you're not directly buying and owning real estate, instead you're investing in somebody else's securities who is owning and buying the real estate, then that opens up a new regulatory framework that you have to fall under, including the Registered Investment Company Act of 1940 and the Investment Advisors Act of 1940. So you might actually have to become an investment advisor in order to be able to advise your fund on buying securities in somebody else's deal. And so then there's proposed legislation that would actually require all deals that a fund of funds invests in would have to produce audited financials. And so that would mean that a lot of the people who these funds of funds have invested with before wouldn't want their money anymore, because that's going to impose a requirement on them to do very expensive audits annually. And they would just say, no, we don't want that money.
Interesting. So are there any ways to structure a deal that is not considered a security?
You can do a joint venture. I don't recommend more than 5 people in a joint venture. I've seen too many of them that fail if they have more than 5 people. The distinction between whether you're selling an investment contract or a joint venture is the investment contract is an investment of money in a common enterprise with an expectation of profits based solely on the efforts of the promoter. Okay, that's the investment contract definition. Well, with a joint venture, you can have an investment of money in a common enterprise with an expectation of profits, but every investor has to be actively involved in generating their own profit. So they're not relying on one person to generate the profit on their behalf. They're all actively involved. And so that is the distinction, is that they have to be actively involved, and it has to be more than just a voting right. So in a syndicate, where someone is selling investment contracts, usually they're going to gather the money all up front. They're going to say, here's how we're going to spend the money, and then they're going to administer it. In a joint venture, it would be more typical that you would not gather all the money up front, that one person gets to decide how to spend. You would ask people for money when you need it to hire a contractor or when you need something. You're not taking control of other people's money.
That's true. And then plus syndication, we are doing to the private placement memorandum, right? So is there any private placement exemption rule for it? That's the Rule 506B and the Rule 506C. So with the Rule 506B that we talked about earlier, if you include any non-accredited investors in your offering, then you're required to provide a private placement memorandum, and the format for that is prescribed by the SEC and some of the content. So you have to make sure that you're gathering a lot more information from your sponsors or your syndicator, our syndicator clients, just to make sure that they can do that. So yes, that would require a private placement memorandum. If you're doing an all accredited offering, technically you're not required to have a private placement memorandum, but we kind of stick with our 5 rule that if you have more than 5 people in your deal or 5 investors, you really should be doing a private placement memorandum, because it's going to have about 7 or 8 pages of risks that's going to explain to the investors all the different things that could go wrong and that could cause them to lose all or part of their money. And in the event one of these things were to happen, then and you've given the investors these private placement memorandum, or you're not going to be held responsible for it unless you did something wrong that caused it. But if it was just the market conditions changed, or some environmental damage happened to the property because of a hurricane or windstorm or something like that, then you couldn't get the right insurance claim. You wouldn't be held personally responsible for that. If you steal money, there is no limited liability. If you lie to your investors or you steal money, then you're going to be in trouble no matter what. And there's no limited liability that protects your personal assets, that all of that can be pierced if you do something illegal. So since we are talking about the private placement memorandum, are there any disclosure requirements, like basic requirements that you have to follow, or you can carve out the way you want it to do it?
Well, the SEC prescribes the format, and it's, there's 2 things. There's what does the regulator say, and then there's what is the industry standard for this thing. So there's both, that you have to look at what the regulators say and then what is expected in the industry, and making sure that you're covering yourself. So an experienced securities attorney is going to know after an interview with you what you're buying, and be able to pull together the risks of that type of an investment. And put it in that private placement memorandum. And also, in addition to that, there's always 2 parts to a securities offering. There's the securities compliance, and then there's your corporate structure. So the securities compliance usually consists of a private placement memorandum, a subscription agreement, and that the investors fill out, saying, asserting that, yes, they do meet these financial qualifications. We'll give them the definition. Are you accredited? Are you sophisticated? Tell us how. They're going to explain in their own words how they meet those definitions if it's a Rule 506B offering. And then they're also going to attest to the fact that they read all the documents you provided. They asked all their questions. They got whatever outside legal or financial advice they thought was necessary. And they understand they could lose all or part of their money. They can afford to lose the money, and they're going to go ahead and invest anyway. So that helps shift the risk of loss from the syndicator to the investors, because they've been fully informed. As a syndicator, you have the obligation to give your investors all of the information they need to make informed consent. And that's disclosing all material facts, including how things could go wrong. And so with the private placement memorandum, and then them asserting in the subscription agreement that they've read it, you've done that. And you've covered those bases. The third part of the securities compliance is filings. We have to do filings with the Securities Exchange Commission, and also with the state securities regulatory agencies where your investors claim residency. And so that's has to be done within a very specific time frame. It's pretty short time frames, within 15 days of when the investors' funds become irrevocably contractually committed. So once we've, you close on a deal, you need to give your securities attorney the information they need to be able to do those filings for you. In some cases, they may have written documents that say that as soon as the money comes in, you have to do the filings. So you've got to be careful about what triggers those filing deadlines and make sure that you're meeting them. The corporate structure is the other part of it. What is your corporate structure? Usually, most typically, you're going to use a limited liability company. It's going to be manager managed. And when you form an LLC, you have the opportunity to form it as member managed or manager managed. In a manager managed LLC, the manager is the one who's responsible for running the day-to-day operations. The investors are passive investors. And all of the rules of how that company is going to be run for the entire period of time that you own the property are laid out in the operating agreement for that LLC. Usually there would be a management LLC. So the manager managed LLC, the manager itself has its own LLC, which is going to be comprised of 2 to 5 people. That could be structured as a joint venture. Or even, there's some alternative structures that can be used when only a couple of people are going to be guaranteeing a loan and the lender wants to know that they're ultimately responsible. Then there's an opportunity for us to use a different structure for that as well. So, it's you just have to kind of marry all these together, make sure that all the documents are 100% consistent and that all the information in them is correct. Usually that's going to be done after you hire your securities attorney. They're going to interview you or give you a questionnaire. You're going to fill it out, and then they're going to create the documents that reflect what it is you're doing. It's your responsibility to make sure it's correct before you send it out to investors.
So you raise an interesting point about the blue sky filing, it's across the nation if you have the investors. So is there a reason behind it? Like every state has a different law regarding the capital raising or something? Or why that's a requirement?
So the reason that Regulation D, Rule 506 is so popular is because it supersedes all individual state laws. And so if you rely on 506B or 506E, you only have to follow one set of rules. But the states are not allowed to impose further requirements on a Reg D Rule 506 offering, except that they can require that you file a notice with them telling them that you're claiming the federal exemption, but you're selling securities in their state, and giving them jurisdiction over you in the event somebody in their state complains to them about the securities you sold them. And so that's a requirement. And of course, they all want fees. So those are the state securities notice filings. As you pointed out, those are called blue sky filings. It's just a way for the states to be aware of who's selling securities, to have you on their radar in the event somebody in their state, loses money and complains to them. And truly, it is the state regulators that are most likely to regulate a securities offering. The federal securities regulators, the SEC, it usually only gets involved in, high-profile cases, really big deals. But the state securities regulators are, some of them, very active in seeking out people who could be, unscrupulously taking money and not doing the right things with that.
So another question I wanted to ask, you always wonder about that. I mean, can you resell the securities that you acquire under a private placement?
And not for 1 year. So there's a lockup period for any securities that are sold without registration. So under these exemptions. So the investors have to be able to attest that they're buying for purposes of investment and not for resale. Right. So that's the point. There is a broker dealer called Second RE that is trying to fill that void. And there are some limited exceptions where they may be able to sell those securities on behalf of a buyer within that 1 year period. But you'd have to talk to them directly about that.
Wow, that's a lot of information. So now I'm going to ask you the question. You have to know all this in order to legally raise capital. So what would you advise my audience here now?
I would say read my book, because that's going to help put it all together step by step and help make sense of it for you. We, goes through the steps of, when do securities laws apply? What are these exemptions? Which ones are available to you? What's a typical corporate structure? How does that look? You can see org charts in there. So I think that's the best thing. If you want my current edition of the book, you can get a free copy of it at syndicationattorneys.com. There's a free book tab. You can get a digital copy, or you can buy it on Amazon. I am updating the book. If anybody wants to go ahead and sign up for the book, they can text the word syndicate to 844-796 3428, and that will get them a pop-up where they can put their own information in, their address, so that we can send them a physical copy of the book when it gets published. It'll be published the first quarter of this year.
Awesome. I'll do that. And then I'll put it in the show notes as well. So what should I ask you that I didn't ask you enough? Because there might be so many things that's not in my perception or in my experience. Then I just feel like I might be missing out something.
I would say that, there's a lot of mistakes that syndicators make that we could cover. And especially new syndicators, it's really easy to kind of get caught into the trap of, well, why do I have to raise money from a bunch of investors? Why don't I just go and raise money from one? Because those investors are usually very sophisticated. They're very specific about what they want. They usually want a lot more than what your individual investors who are putting in $50,000 to $100,000 are going to be looking for. You're basically buying a boss. If you didn't get into this business, if you got into this business because you wanted to buy a boss, right, by just dealing with the same, often they also will kind of string you along, right? And maybe not because they're trying to be cruel, but because they're too polite to say no, right? So instead they'd say things like, well, I would do it if it did this, or if it was bigger, or if, this or that. What really it is you don't have enough experience. You don't have the right kind of deal. They don't want to do your deal, but they're too polite to say no. So they just kind of string you along. You think it's a hot lead. It really isn't. And eventually they just stop answering the phone, or something comes up and they have to invest all their money somewhere else, so they can't invest with you. And I've seen many, many times where people have relied on that and lost deals. Worst case scenario was some people that had worked for months on a deal, and they had one $400,000 investor that was supposed to come to the closing table and it didn't show up.
Get cold feet. Yeah.
You can't, no one's an investor until their money's in your bank account.
That's true.
That's having a conversation, and you can't wait for anybody. And if you're raising money and people are always saying, oh, well, I need time to get my money together. And it's like, well, check with me when you got it and we'll let you know if we still have space. You cannot wait for anybody. You have to just keep raising. If you close on a deal and you have not raised all the money, do not take your foot off the gas. Keep raising money harder than ever. Because once you get into that deal, you learn new things about it that you now have to disclose. And they'll make it harder for you to raise money. And it's easy to get caught up in all of the activities of just running the deal and forgetting to continue to raise the money. And if you don't raise all the money you need to make all the capital improvements that you want, you just bought the same property that the seller just got rid of, and you're not going to perform any better than they did unless you can get those improvements made. So, be careful. You can continue to raise money after closing, but you really need to make a concerted effort to get it all done as quickly as possible. So
and you have to spell it in your PPM that you're going to be raising money for whatever time period after the close. Is that correct statement?
That's right.
How long can you raise the money after the close?
We generally give our clients up to a year from the start of the offering. So that would be the front cover of your private placement memorandum would say when the offering started. We'd file the Form D saying the offering started, and that's the day you can start offering it to people and start collecting money. And you have up to 1 year. If you're going to be raising money for more than 1 year, then we would have to do some new filings with the SEC, and you'd have to update your documentation for your new investors. You might have to, if you have non-accredited investors, you probably have have to do an audit or audited balance sheet.
Okay, we are out of time, but I wanted to ask you one more question now that just came to my mind. So when you're raising capital, even after the close, let's say if I close a deal in 2022 and I'm still raising for it for the closed deal is closed, but I need a little bit more money. So can I still issue them the K1 for the last year for the investors who are coming in the deal this year?
Oh, yeah. Yeah. So you're going to issue the K1 for the investors that were in the deal last year. And then new investors, if they come in the second year, are only going to get a K1 for the year that they came in.
Oh, for this year, for 2023, I cannot issue them the K1 for 2022, right?
Not unless they had invested prior to
Even
this.
though the deal was closed in 2022.
No, you wouldn't be able to, because it's going to track with when the money came into the deal.
Oh, so they track the day the money hit your account. Okay. So
And then you created, and their capital account was created at the time that they made the investment. So if that happened in 2023, then they wouldn't be entitled to a K1 until 2023.
So I remember a very good question. I think I asked you that before as well. When do you say no to money?
When you don't know where it came from, and it sounds too good to be true. You know, the Nigerian prince might be an example.
That's true.
Yeah, I've heard plenty of stories. For a long time, I kept hearing stories about, I have an investor from Saudi Arabia that has $50 million, and it's always $50 million, or from China, right? That has $50 million. You have no idea where that money came from. You have to be very cautious about getting involved with money laundering. There are people out there that would love to use you as a money laundering device. And if you don't know them, you could easily get caught up in that. So if you're taking money from non-US investors, you better know who they are. They better be your friends and family. And if they're, or friends and family of your management team. And if they're not, you're putting yourself and everybody in management at risk. Because and the rules for that are about to get much, much tougher. Starting January 1st, 2024, you are going to have to file annual reports with the Financial Crimes Enforcement Network for every single LLC that you have. And it has to include the tax IDs and the individuals that are invested with you. And it's going to be kind of a big deal to gather all that information, and you have to do it for every entity that you currently own as well. So we actually have some articles about that on our website, and we did a podcast about it as well. But yeah, just be aware that there's some new rules coming that are the financial crimes. It's called FinCEN. Is really starting to look hard at who are the members of all of these different LLCs and making sure that U.S. companies aren't being used as a tool for money laundering.
Yeah, but I think as a syndicator, somebody says they have a LLC and they have a legal bank account here. How much else can you do in order to validate the information that they are giving us, right? Because as long as a legal account, legal LLC, we think it's a legitimate investor.
You still have to get the U.S. bank account. And honestly, you shouldn't be letting anybody invest with you that you haven't gotten to know. Because just because somebody has money doesn't mean you should take it. You really should only take money from people that you know or you've gotten to know well enough that you feel like they're not going to be a liability for you or litigious or some corporate raiders or create some kind of havoc or harm. Because the wrong investor in your deal, just like entering into the wrong interpersonal relationship, can really wreak havoc on your life. And so you've got to be careful who you let into your world, and you really need to take some time to get to know your investors. Even though you can advertise for investors, you should still take some time to have some conversations with them, get a feel for who they are and whether or not you want them in your deal.
Wow. Thank you so much. It was so informative, Kim. We might have to do another session with you, but share one golden nugget with my audience regarding raising capital legally. It's not like you didn't say enough, but one more.
Yeah. So, and this is great. I'm glad you asked that, because you really need to have an investor marketing plan. right? You cannot, this is not a build it and they will come scenario, right? You cannot just say, oh, here's my offering. Everybody, start sending me money. You have to really have an idea of how you're going to meet investors, how you're going to develop relationships with them, how you're going to keep in touch with them, how you're going to prove when you establish that pre-existing relationship so that when you do offer them deals, you're not accused of, solicitation or advertising. You really just have to lay out a plan for how you're going to create a database of pre-vetted investors that you have enough investors to invest in your deals when you have deals. The SEC says the median raise under Rule 506 is $2 million with 14 investors. And, kind of the real estate community, some of the more prominent trainers are saying that you need to have, 2 or 3 times that many people that say yes, because only a half to a third of them are going to come through. And that means that you probably have to have 5 or 10 times that many in your database that are already vetted, because a lot of them are just going to say, I can't do it right now. So you really need to think about, if I need to raise $2 million, I should probably have 50 or 100 investors in my database. And if you don't have that in your database, then you've got a team with other people and co-GP with other people that do. And then that opens up a whole new can of worms of how do you compensate each other without doing transaction-based compensation based on the amount of money raised, because that's illegal. So there's a whole lot of nuances to this. There's a ton of information in my book. Also on our website, there's over 60 different articles, FAQs. So it's syndicationattorneys.com. And then I would encourage you to also subscribe to our podcast, which is called Raise Private Money Legally for Real Estate. So, there's over 60 different episodes with me teaching some subjects and also with me interviewing a lot of people who provide services to the industry.
All right. So this brings us to our rapid fire round. I'm going to ask you 5 questions. You're going to answer in 1 sentence or 1 word only. The first question is, what is one most important thing that you have learned in your life, and how did it change your life after learning it?
I learned how to use meditation to calm down.
I love that.
Keep me honest.
Yeah, because once you're calm, everything is crystal clear. Share 1 book that you have read or recommend to my audience.
I love The Miracle Morning.
Oh, I love that book too.
Yeah. If you're any kind of a funk, use that book. It'll be you.
That's true. In 1 word, what does life mean to you?
I think relationships, are probably the most important thing.
Good one. What is your biggest passion?
I like living a vagabond lifestyle. I like being able to, work from anywhere. And I like teaching. Teaching is my thing. I enjoy talking to people, teaching them, helping them achieve their goals, and helping them figure out the best path to do that.
That's the best quality, right? Share your knowledge with others. That's how it grows. So if you could turn back in time and talk to your younger self, what would you tell yourself and why?
Earlier on. Figure out my path without taking a bunch of deviation routes. I think I guess I would just tell myself, hey, it'll be okay. Don't worry about it. Don't stress about things right now, because it'll all work out in the end.
That's true. You always get there where it's supposed to be. So how can people reach out to you, Kim?
So if they go to syndicationattorneys.com, there's a place where they can schedule a call, either with one of our staff or with me. And we'd be happy to talk to all of you and, hopefully help you further your syndication goals for the year. We do have kind of a low cost option for people to become clients with us. We call it a pre-syndication retainer, but it gets them on our weekly masterminds that I host every Wednesday at noon Eastern time. So that's been really beneficial for a lot of people that have been on those calls.
Thanks, Kim. Thanks for coming to my show.
All right. Thank you, Vinki.